Hello everyone, welcome to Accounting Knowledge. Today we will learn how to prepare adjusting entries. Adjusting entries or adjusting journals are prepared to update the balances of ledger accounts existed in trial balance and bring them to their correct or updated balances. Adjusting entries are prepared to report the actual updated amount of revenues and expenses in a period. So we prepare adjusting entries to update the ledger balances existed in trial balance. To measure net income, timing is very important. Under the accrual versus accounting, companies recognize revenues when earned. So, companies recognize revenues when earned rather than when they receive cash. On the other hand, it also means recognizing expenses when incurred. Recognizing expenses when incurred rather than when paid. Two principles help in determining the amount of revenues and expenses to report in a given accounting period. The number one principle is revenue recognition principles. These principles requires that revenue should be recognized in the accounting period in which it is earned, generally when service is performed. Another principle is expense recognition principle. This principle requires match expenses with revenues in the period when the company makes efforts to generate those revenues. So, expense recognition should be done when the expense makes its contribution to revenue. Why adjusting entries are needed? Adjusting entries ensure that the revenue recognition and expense recognition principles are followed. Adjusting entries are necessary because the trial balance may not contain up-to-date and complete data. Adjusting entries are required every time a company prepares financial statements. Now we are going to see what are the types of adjusting entries. Here we can see there are broadly two types of adjusting entries, deferrals and accrual. And deferral can be classified into two categories. Number one is prepaid expense, number two is unearned revenues. And accruals can be divided into two categories. Number one is accrued revenues, number two is accrued expenses. Now we are going to see the details of types of adjusting entries. So what is prepaid expense? Expenses paid in cash and recorded as assets before they are used or consumed is considered prepaid expense. So any expense paid in advance is called prepaid expense. So if you make adjusting entries for prepaid expense, what would be the effect? Here we can see if you make an adjusting entry for prepaid expense, there will be an increase to an expense. Increase in expense debit, and there will be a decrease to an asset, decrease in asset credit. So what is unearned revenues? Cash received and recorded as liabilities before revenue is earned. So any cash received before revenue earned is called unearned revenues. It's one kind of liability, okay? So if you make any adjusting entry for unearned revenues, what would be the effects? If you make adjusting entry for unearned revenues, here we can see decrease to a liability. So liability decrease means liability debit. Liability decrease here, decrease liability. So liability debit and increase in revenue credit. So what is accrued revenues? Revenues earned but not yet received in cash or recorded. So revenues earned but not yet received, that is called accrued revenues. So if you make an adjusting entries for accrued revenues, what would be the effect? Here we can see the effect will be there will be an increase to an asset account, so asset will be debit. There will be an increase to a revenue account, so revenue will be credit. Accrued expenses. expenses incurred but not yet paid in cash or recorded. It's called accrued expenses. Here we can see what would be the effects of adjusting entry for accrued expenses. Increase to an expense account. So expense will be debit, and there will be increase to a liability account. So liability increase, liability credit. Now we are going to see the practical adjusting entries, how to prepare adjusting entries from a trial balance. Here we can see there is a trial balance with some ledger accounts with their balances. Here we can see cash debit 15,200, supplies debit 2,500, prepaid insurance debit 600, equipment 5,000, notes payable credit 5,000, accounts payable credit 2,500, and other service revenue credit 1,200, owners capital 10,000, drawings debit 500, service revenue credit 10,000, salaries and wages expense 4,000, debit, rent expense 900. So this is the given trial balance. The total balance is 20,700, and these are the ledger balances. But here we can see there is the adjustment. There are some adjustments. So from this adjusting tutorial, we will adjust these 5 items. Number 1 is an inventory count at the close of business on October 31 reveals that Taka 1000 of supplies are still on hand. Number 2 adjustment is on October 1, Aryan Advertising, this is the company name, okay, don't be confused, this is the company name. Aryan Advertising paid Taka 600 for 1 year fire insurance policy. Number 3 is the company determines that it has earned Taka 400 in October from the unearned service revenue. Number 4 is Aryan Advertising, company name, earned Taka 200 for advertising services that were not billed to clients on or before October 31. And the last one is the notes payable requires Aryan to pay, Aryan's company name, so note payable requires to pay interest at an annual rate of 12%. Okay, so this math we will adjust this 5 item. I have written this here again. Number 1 is an inventory count at the close of business on October 31 reveals that Taka 1000 of supplies are still on hand. So Taka 1000 supplies are still on hand, but here we can see supplies has a balance 2,500, but counting has shows that supplies, rest of the supplies is 1,000. So the rest of the 1,500 became expense. So if we adjust this adjusting entry, there will be an increase in expense. There will be an increase in expense. The name of the expense is supplies expense. Okay, 1,500 supplies became the supplies expense. Supplies is an asset, supplies expense is an expense. So 2,500 balance here are here. Counting shows that only 1,000 is on hand. So the rest of the 1,500 became expense. Clear? The 1,500 supplies became expense. So expense increased with the amount of Taka 1,500. So supplies expense debit. On the other hand, supplies has decreased with the amount of Taka 1,500. So supplies decreased or asset decreased, supplies credit 1,500. Now the second one is October 1, Aryan Advertising, this is the company name. This company paid Taka 600 for a 1 year fire insurance policy. Could you please observe this here? October 31, this is a 1 month trial balance. Okay, so we are adjusting this amount for 1 month, but here we can see this company provided insurance policy for 1 year. So this 600 is for 1 year. You can see here prepaid insurance 600. Okay, so we need to adjust this 600 for 1 month because 1 month has passed away. So this prepaid insurance became expense. What is the amount for 1 month? If we calculate this from this is the 1 year insurance policy 600. So if we calculate the 1 month insurance expense, so there will be 50. So this prepaid insurance is an asset. This asset became expense. So the effect, if we adjust this item, there will be an increase in expense. The expense, that means the name of the expense is insurance expense, is increased with the amount of 50. So insurance expense debit 50. So and on the other hand, asset, the name of the asset is prepaid insurance, is decreased. So prepaid insurance is credit with 50. Now the third item is the company determines that it has earned taka 400 in October from the unearned service revenue. Oh, do you know this unearned service revenue is a liability? This liability became revenue because they have earned it. So unearned service revenue is a liability, it has decreased, and liability, here we can see liability decreased. So liability decrease means liability debit because they decrease. So unearned service revenue debit 400, and there is a increase in income service revenue increased, so service revenue is credit. Here the number 4th, adjusting entries, Aryan advertising earned take up 200 for advertising services that were not billed to clients on or before October 31. So they provided service, but there was no receipt from the customer. So service provided, service increased. Here revenue increased, service increased, revenue increased. So service revenue credit 200. And on the other hand, for the service, this company will receive taka. So account receivable, it's an asset increased, account receivable increased, account receivable is debit. The 5th one is notes payable requires Aryan to pay interest at an annual rate 12%. Oh, let's go to the trial balance. Here we can see notes payable 5,000. On this amount we have to pay interest at the rate of 12%. So if we calculate the interest, we will get, do you know, if you calculate this 12% on this 5,000, the amount will be 600, maybe 600. So this 600 will be the 1 year insurance policy, but we are preparing the adjusting journal for 1 month. So 1 month interest will be taka 50. So here the effect of adjusting entry will be expense increased. The name of the expense is interest expense debit, and there will be an increase in liability increase. Name of the liability is interest payable, so interest payable is credit with the amount of 50. So here I have summarized this this one, and this one, and this one, and this one. I have summarized this 5 here. 1 2 3 4 5. Supplies expense debit, supplies credit, insurance expense debit, prepaid insurance credit, unearned service revenue debit, service revenue credit, account receivable debit, service revenue credit, interest expense debit, interest payable credit. So these are the adjusting entry. So from this adjusting entry we will prepare the adjusted trial balance. To prepare the adjusted trial balance, I have again taken the ledger balances. Here you can see I have written the same trial balance. Here you can see this is the trial balance. I have taken these ledger balances here. So these are the ledger balances taken from the trial balance. This is the basic trial balance given in the question, and we will fill up these adjustment columns. Here there are 2 columns, debit column, credit column for adjustment from this adjusting journal or entry. Okay, let's go fill up this adjustment column. Here supplies expenses debit. Let's go. Is there any supplies expense? No. Cash, supplies, this is not supplies expense, this is supplies. Okay, so supplies, prepaid insurance, equipment, notes payable, accounts payable, other service revenue, owner's capital, owner's drawing, service revenue, salaries and wages expense and expense. There is no supplies expense. So if there is no accounts here, we need to create a new here. Okay, at the last row of the trial balance, we will prepare a new accounts name supplies expense, because this account is not existed here. That is why we have written this new supplies expense in the below of trial balance. So here supplies expense is debit with the amount of 1500. So supplies expense debit with the amount of 5000. This is the debit column. 1500 is debit and supplies is credit with 1500. So here this account is exist. Okay, so this supplies account credit. Okay, so we have written in the credit side 1500. Okay, next one is insurance expense 550 debit. Okay, so is there any insurance expense here? No, supplies, no, there is no insurance expense. That is why I have written, or I need to create a new account, namely insurance expense. Here we know the insurance expense debit 50, so I have written insurance expense with the amount of 50. Okay, now prepaid insurance credit. Oh yeah, we have this amount, prepaid insurance. Okay, but here the prepaid insurance credit with the amount of 50. So prepaid insurance is carried here, carried is amount 50. Okay, third one is unearned service revenue debit 400. Here you can see unearned service revenue. So I have written the 400 in the debit side. Please keep in your mind that I am just now preparing this adjustment column. This adjustment column is preparing from these adjusting entry or these adjusting journals. From these adjusting journals we are filling up these two column, that means this adjustment column. Okay, so unearned service revenue debit, so unearned service revenue debit 400. Okay, and service revenue credit 400. So here service revenue 400. Don't be confused, this amount will come forward. Now we are writing this 400, so service revenue credit 400. Okay, and here we can see account receivable debit 200. Okay, so is there any account receivable? No, there is no account receivable, so we need to create this account here, account receivable debit. So the amount of is 200 debit. Okay, here 200 debit. And service revenue, yeah, again service revenue 200 credit. So here service revenue and credit, this was previous amount and the present amount is 200. Okay, so total 600 maybe. Okay, and last one is interest expense debit 50. So this interest expense, there is no interest expense, so I need to create interest expense here. Okay, we have to write this new account name is interest expense. Okay, so here interest expense debit 50, I have written this 50. Okay, so the last one, and here interest payable is carried 50. We have written here interest payable because there is no interest payable here, so I have written here interest payable, but this interest payable is carried, I have written in the credit side. So I have done in the adjustment column. So this is the total 2200. Here 2200 is the total column of adjustment. We will fill up this two column with adjusting this 4 column. Here we can see this is the trial balance and this is the adjustment, and from this to this trial balance, this adjustment, we will fill up this adjusted trial balance. Okay, here you can see cash is debit 15,200, and here there is no adjustment, so 15,200 will be written here. Supplies is debit 2,500, and there is a credit balance 1,500 in the adjustment, So we need to adjust this amount 1500 from this 2500, debit and credit. We need to deduct this 1500 because supplies is actually debit, but here is supplies credit. So we need to deduct this 1500 from this 2500. So the ultimate adjusted balance is 1000. Okay, the next one is prepaid insurance. Here 600 debit, but here 50 is credit. So here is a debit balance and here is a credit balance. So the two different balance, so we need to deduct this 50 from this 600 because prepaid insurance is actually debit, and but here is a credit, so we need to deduct this credit amount. So if we deduct 650 from the 600, we will get 550. Okay, the next one is equipment. Here 5000 debit, but there is no adjustment, so we will write directly to the adjusted trial balance column 5000 debit. Again, notes payable credit 5000. Here there is no adjustment, so we will write directly to the adjusted trial balance column in the credit side 5000, because here this is credit balance, so we will write it to the credit column. Okay, here accounts payable credit 2500, but there is no adjustment, so we will write this 2500 to the credit column directly because there is no adjustment here 2500. Okay, so here unearned service revenue, here is credit balance, here is debit balance, so there is a different two balance. So when there is a different two balance, we will deduct amount. Okay, so actually we know unearned service revenue is a liability. The balance of unearned service revenue will be credit balance, but here is a debit balance, so we need deduct this amount. Okay, 400. Okay, so if we deduct 400 from this 1200, so there will be ultimately remaining 800 credit balance, because here credit balance is the bigger amount, here debit balance is the little amount. So if you deduct the 400, ultimately credit balance, here credit balance 1200, so 400, after deducting 400 we will get 800 credit. Okay, owner's capital account, here 10,000, there is no adjustment, so we will write it to the directly in the credit side to 10,000 because this is credit and this is credit. Okay, owner's drawing, there is a 500, so 500 is debit, there is no adjustment here, so we will write it here to the 500 the debit side. Okay, service revenue, here this is credit 10,000, and again there is two credit, another one is 400, one is 200, so here we can see there is a 600 credit, and as well as here 10,000 credits. This is credit, this is credit, so credit, we need to add this amount. Okay, there is a similar account, this similar account, that means service revenue credit and service revenue always. Here again we can see there is another two credits, so we need to add this amount. So this here 600, here 10,000, so 10,600 credit. Okay, here salaries and wages expense 4,000 debit, there is no adjustment, so 4,000 debit here. Okay, here rent expense debit 900, there is no adjustment here, so 900 debit here. And this new accounts, we also need to transfer this new account salaries expense 1500 debit, so here 1500 debit. Here insurance expense 50 debit, 50 debit. Okay, here account receivable 200 debit, 200 debit. Here interest expense 50 debit, 50 debit. Here interest payable 50 credit, 50 credit. So we have filled up this two column from this four column adjustment. Okay, so this is the adjusted trial balance. Now we will add this column. So if we add this debit column, we can see there is a 28,950 balance, and here if we add this column, we can see there is 28,950. so there is equality of trial balance. So this is the trial balance. So dear audience, I think adjusting entry will be critical if you don't know how to prepare the normal journal entry. Okay, so I would like to request you to go to my previous videos where I have shown the how to prepare journal, how to determine debit credit, and after watching those videos you will come to these videos, and if you face any difficulties while watching this video, you should watch it again and again to be expert here. Okay, practice maximum perfect, so be perfect. Okay, thank you so much.